Here are top 5 macro fundamentals which you can consider as part of your macro framework. Number 1, politics and political stability. Politics and the stability of government is absolutely critical when we're trying to understand financial markets. Market participants have been terrible pricers of risk when it comes to political events, and changes that are happening at government, changes that are potentially happening on fiscal policy, can have far-reaching implications for financial assets and volatility more broadly. Number 2, the inflation versus deflation debate. I always consider the inflation versus deflation debate. It's absolutely critical in understanding what central banks are likely to do. You can always see financial markets, such as equities, really being boosted or thrown around by the perception of what central banks are going to do, and the idea of adding or taking away liquidity based on that inflation or deflation dynamic. So understanding the price pressures or price decreases playing through and what that means for a central bank action and what that means for financial markets is absolutely critical. Number 3, central banks and monetary policy settings. So within a macro framework, we're always trying to anticipate what a central bank's going to do. So we're always taking in valuable information, be it changes in financial conditions, changes in asset prices, changes in economic situations, and we're trying to think in through the lens of a central bank and what they might do with central bank policy within their mandate. So changes, or the perception of changes within a central bank, are absolutely critical within this macro framework. Number 4, relative growth differentials. I always like to understand relative growth differentials, or where you're going to see that growth coming through. If you're an equity trader, you're an FX trader, you're going to be magnetised to where that growth is going to be coming from, whether it's from the US, from Europe, Asia, or UK, or wherever that is in the world. Where you're seeing that better growth is where the capital is generally going to flow, and that's where you're going to see those currencies outperform. So we like to look at relative growth differentials. Number 5, the relative attractiveness of a country as an investment destination. If you consider that the FX markets are really just capital flows, capital moving from one place to another, we've got to consider one country's attractiveness as an investment destination over another one. So if the expected returns in the bond market in Japan or the expected returns in the equity market are higher than, say, Europe, you may see an influence of money flowing into the yen over the euro, for example. So we always like to look at the potential returns and the attractiveness as a place for an investment destination. For more information on using macro fundamentals to trade, head to the Compare Forex website and have a look at the trading guides.